Daily Objective, Jonathan Hoenig here with Josh Dickson and a special guest. And you, our viewers, our subscribers, thank you for taking a moment throughout the world, whether you're in the UK, otherwise known as jolly old England, or in the Americas, or in Europe or Asia. Thank you for spending a little bit of your day and time with us. We've got a great program for you today. As they say, ripped from today's headlines, all about the GameStop / Robinhood phenomena. And it's not just GameStop. And you might say, well, I don't even know anything about GameStop. We've seen the stocks of a number of very small companies skyrocket in the last couple of days, really the last couple of weeks, oftentimes up a couple thousand, a couple hundred, certainly percent in just a matter of days. Now, it's not happening because of economic fundamentals. It's happening because of, I think you could say, a concerted effort by a group of Reddit-inspired, those are a message board, traders, investors, big and small, trying to push the shares of these companies higher. So we're going to get into this today with our co-host, my co-host, Josh Dickson, and our special guest, Seth Levine. But let's welcome Josh. Josh is a psychologist. He's an objectivist. I know a published author and a regular co-host here. So welcome, Josh. Great to be with you.
Yeah, thanks, Jonathan. Good to be here. And I just think it's important today that I'm very much going to be playing the role of the person who knows very little about economics. And maybe I'm the everyman here in terms of, I understand that a lot of people out there are very against, they have a hunch, they particularly feel that shorting is a bad thing. And I don't know much about it. So I think it'd be interesting to have me as that sort of foil in this discussion. And very happy to learn a bit more about it as well from two experts in the field. So
awesome. Well,
and also maybe I can add a psychological bent should you want it.
Well, we're looking forward to that perspective as well. There's a lot of psychology going on here, certainly crowd psychology, and we have a financial professional with us, Seth Levine. He is a well-known blogger at The Integrated Investor. He's also a student of objectivism. You've actually read his stuff on Zero Hedge and in other places in the financial world. Seth, first time with us on the Daily Objective, although I'm told that you are a regular viewer. So thank you for being with us today. And let's just start with getting your perspective on this, GameStop phenomena. What do you make of it?
Sure, it's great to be here, and thanks for having me on the show. Big fans of you guys. First, I have to start with a little disclaimer. These are just my personal views, not investment advice, not views of my employer. So, thank you, SEC, for looking out for all of us for not making that obvious already. But anyway, so back to the topic du jour, GameStop. It's pretty wild. I mean, it really is a really interesting phenomenon. Things like this, and we can get into specifically maybe what people think it is. Regularly happen in the market. It's not super uncommon, though the magnitude of this definitely is. And the magnitude is very uncommon right here. And also I think, and there's also I think an interesting cultural tie-in as well that I'm sure Josh can help us ferret out too. So yeah.
I have to say, I'll jump in and I agree. I mean, I'm a professional investor like Seth, and this notion that there's nothing new under the sun. I tend to actually agree with you. As novel as this seems, as much as this is being played as, this is a revolution, we've never seen anything like, short squeezes, and Josh will get into exactly kind of what that is. That's nothing new. Rampant speculation is nothing new. Message board, if you will, kind of scuttlebutt is nothing new. I think what is new, at least what I haven't seen, is this vehement anti-capitalist mentality, this anti-rich sense of envy. This isn't simply about, Josh, this is probably what you've heard a little bit about, in the press, etc. This isn't simply about jumping on a hot stock. This has become kind of a cultural phenomena of let's get the rich. The rich have been manipulating the market. The hedge fund guys have been screwing us. They're the ones that have been punishing us. So let's punish them by banding together and score one for the little guy. That's kind of how this is being played, is it not?
Yeah, I think I agree. And, it's as old as the lynch mob itself, right? We're actually just tweeted this out recently in the past hour or so, it's like hedge funds bad, lynch mobs good, right? I mean, it's just super interesting because, like you said, so my perspective on this, and the first thing that I think everyone needs to be careful of, especially in investment markets, we're talking about very complex systems. A lot of times the narrative tends out to be a false narrative, right? And the explanation for the causality may not surface for years to come, and maybe never, and maybe not even ever. I mean, if you think about the financial crisis, a lot of people think of it as like a mortgage crisis, but there's actually, I think, more complex factors at play. So, this is just sort of the first read of what's going on now, and just keep in mind that these views may be proved to be fully wrong, in the coming months. But my understanding of it right now is, as Jonathan said, it's a short squeeze. And I would say even coupled with a gamma squeeze, and that's sort of a new kind of buzzword thrown out there. And the gamma squeeze is basically, it relates to options volume. So looking at GameStop, GameStop is it's a brick and mortar retail seller of video games. Some would argue that that business model is dead for good. And there are actually hedge funds that went out into the world to actually put their money behind their views, right? So they went out and they shorted the stock, meaning they thought the business was going down. Right now, it has whether or not the business goes down has actually nothing to do with their shares that they shorted, and we could get into exactly what that means to short sell as well. But basically, they think the business is bad. They think the business is worthless. And that is what they are betting their capital behind. So but the amount of shorted shares from just what I'm looking on my Bloomberg screen here actually exceeds the amount of total float in GameStop. So there was just an absurd amount of shares shorted against GameStop. Now, how short selling works is you are borrowing someone else's shares to sell. So what that means is part of this contract is that you actually have to go and return those shares, right? So it's almost like, hey, Jonathan, like we're going to have an agreement. I'm going to sell your car, but you let me sell it. I'm going to go find someone to sell it at whatever price I can get now, but I'll give you your car back, your car back in, or a similar car, just because shares are fungible, in, a month or so. And you say, okay, whatever, like I'm still going to have my car, the exact same car, and I don't really care what it's worth. So someone else is taking that market bet that these shares should be lower. So what happened is, because there's so many people made that short sale bet, they actually have to go out and find the shares now. So now they actually have to go and rebuy the shares that they sold. Now they were thinking that they could buy it lower. But what happens is, because there's so few shares outstanding that are actually trading versus the amount that were shorted, there's a huge supply demand imbalance. The demand now to buy GameStop shares far exceeds the amount of shares that are actually available to buy in the marketplace. So that's one component of it. The second component is so that's the short squeeze. The second component is the gamma squeeze. Now, very, very complex, but in short, no pun intended, is it relates to option selling and buying. So what these Reddit folk identified was a situation where there's a lot of there's a high short interest. So what they did is they went to basically go poke the bear. So there was this really messed up market structure that they saw as a potential way to profit. They went out and bought call options, right? So a call option is an option. You're basically saying, I have the option to purchase the share at these shares at a higher price. It's a derivative product. We'll leave it there for now.
It's a bet.
Exactly. So they went and made a bet. So they go, but you can't just buy options. They're actually sold through a dealer desk. Your JP Morgan's, your Bank of America, whomever. So they went out and they bought call options. So the desk sold them call options. So the investors are long call options, the betting that the price goes up. Now the dealer's desk are short those call options, which means they don't want the price to go up. Otherwise, they're going to have to deliver those shares to the investor who bought the call option. So what they actually do is they go out and buy the call option in the street to hedge the call option that they sold. In other words, if they go up, they don't care. They have the shares. They just deliver them, right? Or not exactly, but that's kind of the way to think about it. So what happens is you have all this call option buying. The dealer desks now have to frantically buy shares to cover the call options that they sold. And now again, supply demand imbalance. So you have this giant supply demand imbalance that really occurred in this really small kind of esoteric kind of company, and it's just exploded. I mean, it's I've never seen anything like this before. So that's sort of the fundamentals of what I believe is happening now. Again, I mean, that's the best explanation I have.
And let's put it in a little context too here. I mean, you're describing, Seth, I believe you're describing, a short squeeze. It happens all the time.
Yeah.
But look at the context. We're in the midst of what's been a huge bull market. This is a chart of the price. You guys can see this. This is just a chart of basically the valuation of the market. Now, going back to 1995, we are, in terms of the S&P 500, now exceeding the price sales ratio. So it's a frothy time. And just to give you a sense of contrast here, this is the NASDAQ back in 2000 to 2002, a much different chart than we have today in terms of stock prices. And I remember the West Wing at the time, the episode 17 People, you guys might remember this in the UK as well. The West Wing actually had a joke where the guy says, the NASDAQ just filed for non-for-profit status. So, we're in such a different time right now. This is a time of real, it's a time of mania. Here's a chart of small traders call option trading in the last just couple of months as against the last decade. So we've seen this explosion of speculation in the marketplace. This is call option volume. These are some charts from Zero Hedge, and all credit to them. So, we've just seen this explosion of speculation in the marketplace. I'm trying to make the point, I guess, that I don't think we could see this type of gamma squeeze, as you're talking about, Seth, or short squeeze. We couldn't see this in 2009, at the midst of the global financial crisis. There's a lot of easy money out there. The 0% interest rates, people are trying to, find a place to put money. You're not getting incentivized to put it in the bank. So I think there is an incentive now to buy, as they say, AOT, any old thing. And exactly, GameStop. Look, people have been buying Bitcoin for years now, making a lot of money. There's not a real, so GameStop, but even what you're describing, Seth, this idea of looking for low float, highly shorted stocks. Again, getting back to the idea of this is nothing new. Here's a chart. They've published days to cover for decades now, and the idea is you look for stocks that have high days to cover. That means how many days would it take to cover all the shares that are sold short if you wanted to reverse that short position. So, I just go back to this. There's nothing new here.
Yeah, and actually, I know you're a pretty big student of financial history. If you go back and you read, the Reminiscence of a Stock Operator and other kind of books from that time period, they talk about pool operators looking for weak hands in the market and shaking them out. This idea of looking for ways to profit from, kind of market structure phenomenon. I'll just kind of use a broad word, is nothing new, and it's quite genius in its strategy, altogether. So it's actually pretty genius what these Reddit kind of people did, and the proof is in the pudding in terms of of how profitable this trade has been. But it's the cultural.
Josh was mentioning, there's an animosity towards short sellers, right? It's kind of like, oh, they're just screwing us.
Yeah, well, what you tend to get is Steve Jobs good. It's still Steve Jobs is good. CEOs are good because they make the phone. And what happens is the AirPods or whatever it is, and then these hedge fund guys, they just press buttons on the computer, screwing over little people.
Yeah. We price the phone.
I know that's what you do, but people don't understand that. That's what the mentality is that what these guys do is they do super little tricks, and they become multi-millionaires in like 1 month, and then they buy up everyone's property everywhere, so no one can buy a home, and so on and so on and so on and so on. Why aren't people making the phones? And also, like, one thing I wanted to ask the two of you in all of this is, are these people, have they been too clever by half, and are they going to come really unstuck by this? Is there something around trading in the market that they haven't factored in, and they're suddenly like not nearly as clever as they think, and this is going to bite them or not? Because this is the way it's been presented, say on social media and things, is this is a real way to really screw over the hedge fund people, like they've screwed over other people. And actually, is this going to come back and make a whole load of hedge fund people actually more rich?
But I reject that whole notion of, and you know what? It was the same thing in 2006 and 7 when oil prices were going up. Who do they blame? The hedge funds. And it was the same thing in 2000 when the market went down. Who do they blame? The hedge funds. It is always the hedge funds.
Right.
And what is that? That is a blame of basically people who are seeking to profit, financially profit. I mean, that's what it is. It's that envy, it's that hatred of, I think, people who work with money, people who use money to make money, that always comes out. And in this case, that's just, so I mean, the truth is, I think some hedge funds are probably short GameStop. I have friends, rich individuals who are short GameStop. There's a lot of, so, it's not a political statement to make a trade, and you're not screwing anyone when you buy GameStop or anything else. You're just taking a risk. You're maybe you're going to win, maybe you're going to lose. But this idea, and Seth, I want your perspective on this idea that somehow you're screwing the rich by buying a stock. Look, you're taking a risk. At the end of the day, that's what it is. It's not a political statement.
Definitely not. And I actually have two things to say about that. First, I'll say the more profound thing first, so we maybe come back. But I see that as a very deeply seated in altruism. It's very much, the strong getting, preying on the weak, right? So I think there's a lot of, I think that moral vicissitude that you're picking up is really, deep-seated altruism that I think all of us have to struggle with, because it is the default. It is the default sort of philosophy out there, or ethics out there. But the second thing is, anyone who's met a short seller, like, there is no harder way to make money on Wall Street than short selling. I mean, it is very hard. And the people I find most short sellers out there are some of the most thoughtful people in all of the investment markets. And these aren't, for the most part, like, they are the financial police. Frauds, like the SEC and the regulators, they're not really detecting frauds. The people who are out there shaking out the frauds are the short sellers, and you see them, and that they actually play a very vital role in the in just the health of the markets, right? Because there actually are frauds out there, right? I mean, there are bad people, and a lot of times the short sellers can kind of tease them out.
Yeah, and I'll make the point. Oftentimes, when you go to buy a stock, who do you buy it from?
That's true.
You oftentimes buy it from a short seller, someone who is taking the other side of that trade, either for a couple of minutes, for a couple of hours, for a couple of days. And, Seth, what you don't realize is you realize, but what many people don't, and Josh, this might be somewhat of a new concept, and thank you to Marilyn for your contribution. People who are sold the stock short are actually buyers of the stock. They're supporters of the stock, because, as Seth, as you said, they have to eventually cover those shares. That's exactly what we've seen with this short sale. So people who have this animus, this animosity towards short sellers, they're trying to actually price the stock accurately, and ultimately they're the ones who are going to be buying it back.
Yeah, and also too is very few people out there in terms of the overall percentage of short selling are doing what's called naked short selling. They're just not going out there and shorting stocks. A lot of times they're part of these complicated trades. So maybe they're shorting one stock that they think is going to go down because they're buying even more of another stock that they think is undervalued and should go up. And so there's this whole ecosystem where the short sale really helps. It's a risk management tool that really the entire financial system relies upon. If you ban short selling, what you're going to have is all these funds that use the short as for business reason. they're going to go out there and just have to liquidate all their long positions. And those far outweigh kind of the short positions. I know we're getting a little bit kind of in the weeds here of the investment world, but I think like the main takeaway is like, this is not just cut and dry, short sellers bad, long good, right? I think that's, I mean, it's a very important point there. And even
let's go to we have a super chat question, and thank you to El Pierno Pequino has a question for all of us. He asks, is the manipulation of the stocks by short sellers or Redditors a violation of property rights? Is the manipulation of the stocks by short sellers or Redditors a violation of property rights? And I want to go to you, Seth, but my response would be, check that premises. What manipulation of stocks? I mean, I don't see a short seller as manipulating a stock, nor do I see a Redditor who's buying a stock or banding together with other people to buy a stock. But, I don't see that as manipulating at all. They're, at the end of the day, what are they doing? They're trading, they're buying, they're putting their money on the line, they're expressing, and, let the longs or the shorts ultimately win. So I check that. So I don't see any violation of property rights here. The only violation I'll say I see of property rights coming in here is government. Now, people don't probably realize this, is that government is now mandating, not recently, but basically since 2008, these trading halts. So they say a stock can only fall, let's say 20%, then we have to have a cool down period. That actually makes the market more volatile. So no, there's no violation of property rights or manipulation, in my opinion, when it comes to trade. And even this so-called Robinhood shutting down people's accounts, saying, that's basically because they're running out of money because of SEC requirements. SEC says you have to put up more and more margin money. That's causing them to be able to say, we can't take that risk. So I don't see any violation of property rights. I don't see any manipulation here. I see, just to a large extent, the market at work. Seth, what say you?
Yeah, sorry, I'm getting a really weird glare kind of on my screen here, so that's just me trying to make it better. Yeah, I think that's a great point, Jonathan. Like, check your premise. Like, what manipulation is there? Now, I think there's a distinction that we may want to make between, is it legal versus is it moral? Because a lot of times the legal laws don't follow what I would say is moral, but that's a separate issue. So, I don't see any issue here, because when you actually hold the stock with a custodian, right? If you buy a stock, right, you have a brokerage account, and they are actually holding your shares for you. It's actually a service that they provide. It's called a custodian, right? You don't want to just have shares laying around your house. Like, what if someone breaks in your house and steals your shares? Then you're screwed, right? And also, how would you sell that? You'd have to take it somewhere. So this whole custodian's kind of infrastructure is actually a market evolution. So I have an account with Fidelity. I buy my shares from Fidelity. Fidelity holds them in my name for me. Now, we have an agreement that we may or may not know, which is another thing. But, like Fidelity, you actually agree to let Fidelity use your shares for their own business purposes. So Fidelity is going out and they are actually lending it to short sellers. And that's how Fidelity makes some money. And actually, by Fidelity lending out your shares, you actually are benefiting indirectly by having lower fees, like later on down the road. But that's kind of a Bastiat, like, unseen kind of phenomenon. So, there aren't any sort of, I don't see any like contract violations or anything kind of sneaky going on here. Like, it is all kind of, yeah,
and I'll just say this idea that people say, oh, we've been screwed for so long. It's Dave Portnoy and all this. It demonstrates real ignorance. There's never been a better time to be an investor. You trade for nothing. People are saying, oh, I'm getting ripped off by the market makers. The market maker is going to pay 1/10 of a fraction of a penny better price than you are. And in exchange for that, you trade for free, you buy and sell instantly. And, as they say, I'm old enough, Seth, and maybe Josh, you are, to remember when to buy a stock, you had to dial up, call, wait on phone. Oh, I'd like to buy. You'd pay $20 or $30 to trade those 100 shares or 50 shares. So the markets are great. They've never been better for investors, big or small. And I think this hatred of the rich, hatred of the financial industry for supposedly screwing people. It just demonstrates major ignorance and of history, even recent history in the markets.
Yeah, I would agree.
Josh, jump in here.
I take your word for it. I'm slightly a little bit whew, there, but
Okay.
I'm really enjoying both of yours passion for the subject there, and I think honestly, I think this brings out part of the problem is I have no objective opinion around this in general, and therefore I'm not going to comment.
Yeah.
But there's plenty of people on my Twitter feed who seem to be experts. Like there's a similar thing going on at the moment with the vaccines in the EU, and the UK bought some vaccines, and then the EU's come along 3 months later and claiming this, and they published the contract out, and the EU's claiming one thing, and so on. And I go on my Twitter feed, and there's all these people who are suddenly senior contract experts, and right. I'm seeing 20-year-old kids, 22-year-old kids on Instagram who are suddenly experts on short selling and why this is outrageous and so on. So I just see that kind of that naive and desire and that sort of naive knowledge to assert what you believe, combined with massive virtue signaling about something that most people don't know anything about.
Yeah, and if I could jump in here too,
that's what I see.
Like, I also think this is also the mixed economy is largely to blame here. Like I think a lot of people see bailouts and getting kind of quote unquote screwed by, they'll call it the big guy, but I think we would further identify it as being the politically connected at the expense of like the little person. And it happens a lot in financial industry because I shouldn't say it happens a lot, but it's very visible in the financial industry, and you see it in the financial industry because it's big business. And I think anywhere where you have big business, and you have a mixed economy, your cronyism, is going to go through the roof. I mean, that's just, I think that's just a virtue of the mixed economy. So I think people correctly react negatively to the cronyism that they see. And
but then
I think that's right. But then
they blame capitalism.
That is correct, which we know is not capitalism, right? It's actually a function of statism. So a lot of time, how I spend a lot of my Twitter time, I guess, if you want to call it that, is I try and just call it out as cronyism. Like it is not capitalism, right? I think we know here that the only way to get rid of the actual cure for cronyism is capitalism, right? And I don't think many people would sort of get that intuitively, right? I think it's it needs to be illustrated, I think, for most people. So I think that whole cronyism equals finance equals bankers equals hedge funds equals fat cats on Wall Street. I think that's how it manifests, like in the pop culture, and that's why I think there's such visceral hatred. Hatred for this as well, so it kind of feeds into it.
Here, this is a screenshot last night. I'm told of from Fox News, and how is this being played out? This is as I say, the lower thirds. Hedge fund market manipulation exposed. So it's going to be that hatred, that animosity, and towards business, towards financiers. That as I said, I was on before it was Tucker, it was Bill O'Reilly. And I was on as a guest when it was hedge funds who were exploiting, screwing people with energy markets. They were the ones supposedly pushing up the price of energy. And I'll also just point out, I pulled up another screenshot here. This notion that it's with this Reddit phenomena is something new is not true. I mean, back in the late 1990s, it was ragingbull.com and internet postings back then that were moving stocks, at least for the short term. And I'll just say this, and we don't want to go too long, but people who say that they can short-term trade and make money in the market, go for it. I think more about power to you. Yeah. We have some people in the chat who are saying they've been long GameStop, they've been short GameStop. I say good luck. And my experience, having doing this for more than 20 years, is that it's very difficult to make money in the market, short term especially. And those who are doing it and say at anyone's expense, I say, go for it. Good luck to you as a result.
And
I think,
Jonathan,
Rand talked about how the, money is made thinking long-term, thinking long range. And I think that's very true in the markets. And these people will ultimately find that out by themselves.
yeah, and just to add one more thing. So even going back to the GameStop ire and even Portnoy, they're saying that the regulators are now stepping in to bail out, right, the hedge funds, right? They're stopping it. Per se, and like that may actually, I don't know, I don't have an opinion on this. And going to Josh's point, way too many people have an opinion on this without having any facts. But to the extent that hedge funds go and do this, I mean, it wouldn't be beyond me, for a hedge fund or any financial company to actually use the regulator who they've captured for in their own crony way. And again, I would just highlight that is cronyism. If a hedge fund can go out and use the power of the regulator for their own, to stop them out of a trade or help them out of a situation, that's not capitalism, right? We should be like that. That is a legitimate sort of gripe to have with the sort of hedge fund industry. But they're just operating in the mixed economy. And this is, as kind of Rand said, like, this is what's so vicious about the mixed economy. It turns ordinary people into villains.
I agree with that. Although I have to say, I'll share one more screenshot. This is from Bespoke, who is a real reputable research firm, and they demonstrate how what they describe as the free to trade brokers. This is their research, but here's a shot. Their clearing risks, their funding requirements have gone up as the volatility of these stocks have gone up. So this notion that it's this cabal of hedge funds that are screwing the little guy, maybe it's not a great idea for you to trade in stocks that you don't know anything about, long or short. I just think it's this is emblematic of the time we're in, this very speculative froth. And thank you, Zalmi T. Thank you, Daniel Kraus. Daniel asks if we can recommend any trading apps. I'll speak for Seth when I say that we can't and we won't. And probably Josh as well, but thank you all for those contributions and this perspective. We'll go around the horn one more time. I know we try to keep this daily and not too long, but we've touched on a lot of issues here and there's a lot more to come. Josh, have we kind of satiated or satisfied your suspicion? I know it's not you, but your suspicion of short sellers. You can understand kind of the value that they provide to the marketplace in terms of how to set prices.
Yeah, 100%. Yeah, no, absolutely. In the same way, like once someone explained price gouging to me, I think it was Harry Binswanger. Got it. Yeah, got it.
Well, that's awesome. And, objectivists are among the few really now. I see even so-called libertarians now talking about how wonderful this is, that the hedge funds are getting screwed. It's just, it leaves me shaking my head. And once again, I think we're on the side that is most objectivist, on the side of reason, on the side of capitalism. And Seth, over at the Integrating Investor, you are always presenting such reasoned, I think, perspectives on markets. Thank you for adding your perspective for us here today. I hope you'll come back.
Sure, thank you. Anytime, it's blessed.
Do you have we'll give you the final word here, any departing perspectives on what you're seeing in the marketplace, or maybe on where you see things going with respect to this GameStop phenomena?
Yeah, I would just sit back, pop the popcorn and watch it. Have an open mind. Try not to get caught up in the emotionalism of it all, because there's a lot of it now, and I see a lot of very smart people who I respect a lot jumping to some pretty large conclusions that they may or may not have any basis for making, and that's kind of what defines a mania, I guess.
Well, I think the conversation will continue. It's continuing online. Thank you, Christopher, Kirk, Daniel, all of our commenters, our subscribers. Please do that. Subscribe to our YouTube channel, share this conversation, and ring the bell, as they say, so you'll be informed next time we're live on air. So we'll be back throughout the week and here on the Ayn Rand Center UK channel. So thank you for joining us, and thank you for being with us. I want to remind you that at 10 p.m. UK time, and although I'm here in the United States, actually I set my watch 2 UK time. So I'm always abreast of what's going on in the United Kingdom. At 10 p.m. UK time, 5 p.m. Eastern, The Psychology of Atlas Shrugged. Today, we're going to talk about Eddie Willers, who I think is probably among the coolest characters from Atlas Shrugged. So tune into that. And Josh, I know you've been a big part of that. And Seth and I have been oftentimes viewers, so we'll be checking that out. Thank you all. Thanks to our listeners, our viewers around the world. We'll see you next time here for the Daily Objective. Have a great day and a great evening as well.